Let's continue with spot and forward plays, futures and option, hedging and speculation, and currency swaps. We already have covered about the futures. Now we'll discuss about the differences between the futures and forward contract. The futures market, which is very specific to the few currencies. We already have discussed in our last lecture that the futures market is limited to only few currencies. And those currencies we already have discussed like Canadian dollar, Australian dollar, etc. So you need to convert first your own currency into their currency when you want to trade or participate in the currency trading. And it's also very specific to the geographical locations such as Chicago, New York, London, Frankfurt, and the Singapore. The futures market is also very limited to the small firms. Whereas if you want to go with the forward contracts, the large firm can also be the part of it. The futures contract can also be sold at any time before the maturity, until the maturity, but the forward contracts you need to wait for the 3 months or less than in a year, which is applicable to your contract. Now let's discuss about the foreign exchange options. Since year 1982, individual firms and the banks have also been able to buy foreign exchange options in Japanese yen, Canadian dollar, British pounds, Swiss francs, and euros on the Philadelphia Stock Exchange and the Chicago Mercantile Exchange since year 1984 or from a bank. A foreign exchange option is a contract giving the purchaser the right but not the obligation. You can choose a buy option, which is called a call option, or if you want to sell, you need to choose a put option. And if you want to trade your currency on a stated date, then it is a European option. If you want to trade it before the stated date, then it is an American option. And if you want to go with the stated price to exercise it, then it is an strike or exercise price. The buyer of the option has a choice to purchase or forego the purchase if it turns out to be unprofitable. The seller of the option, however, must fulfill the contract if buyer so desires. The buyer pays the seller a premium, which is an option price, ranging from 1 to 5% of the contract's value of this privilege when he or she enters the contract. If you want to compare this foreign exchange options, then these are less flexible than the forward contract, but in some cases they are very useful too. Now let's talk about the speculation, but it's opposite of hedging. What is hedging? When people want to avoid the foreign exchange risk, then it is called hedging. So speculation is just opposite of hedging. It means a speculator is taking risk. A speculator accepts and even seeks out a foreign exchange risk or an open position in the hope of making profit. Speculation can take place in the spot forward futures or option market. Even the hedging is also taking place in all such markets. So first, we need to discuss about what is hedging. Hedging refers to the avoidance of a foreign exchange risk or the covering of an open position. Let's take an example over here. The importer and exporter are meeting within contract or entering into a contract, which it means the exporter would fulfill or would supply his order to the importer after 3 months. But today they are entering into the contract on a specific spot rate, that is $1 is equals to euro 1. And based on that, the importer has some uncertainty about the coming 3 months. So that is why this importer could borrow today this euro 1 lakh on a given spot rate, which is $1 by euro 1, and can deposit this amount in a bank to earn some interest rate. And then he can leave it for the 3 months. So this whole procedure, when he is buying, he's actually taking a loan, and then this amount he is depositing in a bank for another 3 months to save his risk or to avoid the risk which he may experience after 3 months when the exporter would give him the delivery. Therefore, hedging is the practice of taking a position in one market to offset and balance against the risk adopted in the other market. He may also enter into the forward contract, and also he may go with any kind of investment or maybe a swapping, like in a two separate market he can do to avoid his risk, which is being experienced in the contract between an importer and exporter. So like similar like importer, this exporter can also avoid the risk. An exporter can also, you know, uh, can go for depositing this amount to a bank to earn some rate of interest. But the hedging may also incur some cost. And this cost is basically a positive difference between the interest rate the importer has to pay on the loan of euro 1 lakh and the lower interest rate he or she earns on the deposit of euro 1 lakh. So this positive difference is the cost of hedging we can consider over here. Now we'll go with the speculation. So first of all, what is this? It refers to the acceptance of a foreign exchange risk or open position in the hope of making a profit. As we all know, a speculator is taking risk. And if he anticipates correctly in a spot market or in an option market or in a futures or in forwards, he will gain profit. If he anticipates incorrectly, he may experience losses. So in a spot market, if a speculator believes that the spot rate of a particular foreign currency will rise, he or she can purchase the currency now and hold it on deposit in a bank for resale later. If the speculator is correct, the spot rate does indeed rise. He or she earns a profit on each unit of the foreign currency equal to the spread between the previous lower spot rate at which he or she purchased the foreign currency and the higher subsequent spot rate at which he or she resells it. So the difference of this is the gain for the speculator if he anticipates correctly. Otherwise, he may bear the losses. Speculation in option market can also anticipate and can exercise the option, buy foreign currency in the spot market and receives the payment by exercising the option and earns the profit. When a speculator is taking a long position, a speculator is buying today this foreign currency from the spot market, forward market, or a future market or any market, and he is having the expectation of reselling it at a higher future spot rate. Then he is taking a long position. When he's taking the short position, when he borrows today or sells today a foreign currency in this expectation that in future time he would buy it again at the lower prices, then he's taking the short position. Then what is stabilizing speculation? When our country's exchange rate is falling and somebody is purchasing foreign currency, then it is a stabilizing speculation. Or we may also consider in this way that if our exchange rate is rising, then somebody is selling his foreign currency. Then it is also the example of stabilizing speculation. Then what is destabilizing speculation? In the case of falling foreign exchange rate, if speculator is selling foreign currency, then it is the destabilizing speculation. In the case of rising foreign exchange, if speculator is purchasing foreign currency, then it is again the example of destabilizing speculation. To understand it more, we'll go for the next slide. This is the case of falling foreign exchange rate situation. We are taking here the example of stabilizing speculation. Now let's consider this first point. This is an equilibrium situation. Here we are taking the exchange rate. Here we are taking the demand and supply of foreign currency. So basically we have here the exchange rate situation, that is euro 1, which equals to $6. And if we consider this is an equilibrium situation, so we are arrived here the foreign exchange demand and supply position at the equals to 1. So this is a stable position that we already have assumed. Now what happens? If the foreign exchange of our country or the home nation is falling, it means the foreign currency's demand is reducing. Okay? Or we say the supply of foreign currency is increasing. So we reached on the point which is what the second over here. Okay? So instead of coming demand curve downward, a supply curve is coming downward and we arrived on the situation of 2. We were here at 1 where we assume that euro 1 is equals to $6. This is a stable condition. And from this situation, we reach to the 2 because there is a falling exchange rate for our nation when the supply of foreign exchange is increasing, because there is an auto demand of domestic currency or the dollar over here. Okay. But this situation is again reaching on the 3, and this is giving you the same stable condition, which is euro 1 is equals to $6. Now, what is this situation? This is giving you the demand curve rise, which is D1 to D2. Means in the falling exchange rate situation, a speculator is demanding for foreign exchange. It means he is buying foreign exchange, and because of that, this demand curve is shifting from D1 to D2. And you are again reaching on the stable position. That's why we call it stabilizing speculation. Again, from 3 to 4, we are coming down. It is again the situation of falling exchange rate, means the demand of dollar is rising and the demand of or the supply of euro is increasing. Then again you're reaching on the 5 because the speculator is buying this euro and you are reaching on the stable position. So we call it stabilizing speculation. Now what happens here in case of destabilizing? The falling situation of exchange rate, you are reaching to 1 to 2, 2 to 3, 3 to 4, 4 to 5. But nowhere the demand curve is shifting. Means no speculator is demanding to purchase this euro from this economy. It means there is no demand of euro. If nobody is demanding this euro and everybody is only selling, so why 1 to 2, 2 to 3, 3 to 4, 4 to 5 it is coming up? Because from one situation to two situation where the country has arrived because of the falling exchange rate, the speculator is thinking that in future the price of euro would not increase. So that is why they are selling it in the falling exchange rate situation. So you are coming from 2 to 3, 3 to 4, and 4 to 5. That is why this is the situation of destabilizing speculation. You cannot recover the situation of 1. Then rising foreign exchange rate situation in stabilizing speculation. Coming up to the 1 situation where it is equals to the stable condition, and this is reaching to second position. The reason because now there is a rising situation of foreign exchange rate. It means demand of euro is rising and the demand of this dollar is declining, or we say the supply curve of dollar is coming down. The more dollars are available in the economy. But what is happening? When the demand curve is increasing from 1 to 2, okay, you're reaching on D2 position, second position, but from 2 to 3, why you are coming down? The reason because some of the speculators may think in the rising foreign exchange rate situation, they would sell it because of gaining more profit. They do think that today it's a more profit, and after that they cannot earn this much of the profit, and that is why the supply of this foreign exchange is rising. From 3 to 4 again you are reaching. This is a rising foreign exchange rate situations. The demand of foreign exchange is rising, but again the supply of foreign exchange is increasing because some speculators are thinking that they would earn today, they'll not earn this much in the future. Now, what is happening in case of destabilizing speculation? From 1 to you are reaching 2, 2 to 3, 3 to 4. It means from 1 to 2, which is the situation indicating that a rising foreign exchange rate situation. But from 2 to 3, the speculator may think that today, what prices they are getting, that will also increase in the near future. So they are not ready to sell foreign exchange. And that is why the supply curve would remain constant. It's not fluctuating. And that's why the speculators, the economy is shifting, or the exchange rate is shifting from 2 to 3, 3 to 4, and so on. So this is a condition of destabilizing speculation. The difference of hedging and speculator, we all already have discussed about that. The hedging, we are covering our risk. Speculator is actually anticipating something for taking a risk. And this risk is the source of profit. The hedger is avoiding the risk based on paying some cost of it. The speculator is taking risk, and the risk is the only cost of it.